Welcome to Accounting in Focus. Okay, now let's talk about how to calculate target income. That is the profit that a company wants to make, right? Because we talked about break-even point, but businesses are really in the business to make money, not to break even. So businesses want to be able to plan for a target profit. In the break-even point video, we discovered that break-even point is equal to 8,000 units. Say we want a target profit now let's pick a number here. Let's say $15,000. Okay, so target profit $15,000. Break-even point we said was 8,000 units. So how do we figure out target profit? Well, let's take a look at our income statement again. Let's bring that back up. Sales minus variable cost is equal to what? Contribution margin minus fixed cost gives me operating income. Okay, target profit is another word for operating income. Okay, so we would say in this example, I want my operating income to be 15,000. We know that our fixed costs are 30, 16.5 and 13.5. It's 30,000. So what would my contribution margin have to be to cover fixed cost and profit? Well, in this case, I'd have to add these two together. So my contribution margin has to be 45,000 because 45,000 minus 30 is 15. Remember from break-even point, sales are 10 minus variable cost of 625 gives me a contribution margin per unit of $3.75. So what do I do now? Well, I take 45,000 divided by 375 because the relationship between these two numbers is the number of units. So if I want to know how many units I need to break even, I would need 12,000 units. Okay, 12,000 units is the number of units I would need to achieve my target income. Now let's prove this. Let's do the income statement. But what I want to do for the income statement is I actually want to use some of the other tools. Let's review some of the other tools we have. It's operating income. Now, how can I go and get directly to sales? Well, remember my contribution margin ratio? We determined that my contribution margin ratio is 37.5%. My variable cost ratio is 62.5%. Okay, so let's use the ratio. So if I take fixed cost plus operating income divided by contribution margin in units, that equals units. If I take fixed cost plus operating income and divide it by contribution margin ratio, I get dollars. Okay, now notice here's a little tip. If you're working on break-even point and target income, what's my operating income at break-even point? It is 0. So you could actually just remember this one formula and realize that at break-even point OI equals 0. Okay, so that's just another trick that you could use to get you through these problems so you don't have to memorize as many formulas. So if I want my sales in dollars, okay, I'm going to take 30,000 plus 15,000 divided by 0.375. And what does that give me? That equals, if I do the math, 120,000. Okay, you could also take 12,000 units times $10 per unit. Okay, so my sales are 120,000. See, through the magic of video, I got rid of that stuff that was there. Very exciting. Now my variable cost. Okay, so I could take 625 and multiply it by the number of units. Okay, and that would give me my variable cost. Let's use our ratio instead though. 120,000 times 62.5%. What does that give me? That gives me 75,000. Okay, which is the same thing you would get if you took 12,000 units times 625, you would get 75,000. What I'm trying to do though is I'm trying to get you to think in different terms, okay? So you can use the variable cost ratio and the contribution margin ratio whenever you need to. If I subtract these two numbers, I get 45,000. And again, I could have used my ratio here. I could have said 37.5% times 120,000 is 45,000. Subtract my fixed cost, and I get 15,000. Always make sure, take the extra minute or so and make sure that your income statement actually works. It's a great way to double check to make sure that you did your math correctly and you didn't make an error.